Hello and welcome to today's video. As most of the healthcare names have reported their latest earnings, now that the emotions have settled down, I will take my time by going throughout each company earnings and earnings call in more detail, starting today with Elevance Health. So without further ado, let's start. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. First, on the earnings highlights. Elevance Health reported revenue of $50.1 billion, up 12% year over year, or roughly $5.4 billion in absolute growth. The company benefit expense ratio rose to 91.3%, an increase of 180 basis points compared to the last year, signaling higher medical costs relative to premium earned. Now onto the earnings per share. It came in at $5.32 for the quarter and $22.67 for the first 9 months, representing a 4.8% decline year over year. On an adjusted basis, EPS stood at $6.03 for the quarter and $26.88 year to date, a 9.6% decrease from the prior year. Operating cash flow for the year to date period reached $4.2 billion. During the quarter, Elevance repurchased 2.9 million shares at an average price of $303, while also paying a quarterly dividend of $1.71 per share, amounting to $381 million in total distributions. As of September 2025, the company still holds $7.2 billion in remaining board-approved share repurchase authorization. Now onto segments of their business. First, health benefits. This core segment generated $42.2 billion in revenue, up 10% year over year from $38.2 billion. The growth was primarily driven by Carelon RX and Carelon services. The Carelon pharmacy benefits arm delivered $10.9 billion in revenue, up 20% year over year, while Carelon services surged to $7.3 billion, marking an impressive 58% increase. Looking at the 9-month period, health benefits grew 11%, Carelon RX 22%, and Carelon services an outstanding 61.5%, highlighting strong momentum in Elevance's diversified healthcare platform. Despite top-line growth, operating margins declined across all segments. Health benefits 1.4% down, Carelon RX 5.1% down, and Carelon services 3% down. It is all compared to year over year. This compression reflects elevated medical costs, ongoing integration expenses, and a more competitive pricing environment. Now onto some positive takes from their earnings call. So Medicare Advantage costs came in slightly better than expected, helped by disciplined plan design and favorable member composition. Management now expects a small improvement in operating margin for 2025, signaling early stabilization after a difficult year. Next, by 2027, around 55% of Medicare Advantage members are expected to be enrolled in 4-star or higher plans, up from 40% for 2026. That improved points towards stronger growth potential and higher quality-based reimbursements in the years ahead. Now onto the AI relations. By the end of the year, more than 10 million members will have access to Elevance AI-enabled virtual assistant. The company also confirmed a partnership with OpenAI, although without further details. These initiatives could improve efficiency and engagement and long-term cost control. Onto their capital allocation, Elevance reiterated its commitment to returning capital to shareholders throughout continued share repurchases, reinforcing confidence in the strength of its cash generation and balance sheet. And lastly, Carelon remains a growth driver, so its pharmacy and healthcare services continue to offset part of the weakness in the health benefits segment. Discussions with the states are now expanding beyond rate adjustments, focusing more on a program design and cost management levers that could enhance sustainability over time. Now onto some bad takes from the earnings call. So the company expects 2026 to be still a challenging year for Medicaid margins, as they will reach their lowest point, with ongoing re-verifications and shifting state programs reducing profitability. Full-year Medicaid operating margin is now projected to be modestly below break-even, roughly negative 50 basis points. Next, if enhanced federal subsidies expire, Elevance could face a significant drop in membership during 2026. Management is still waiting for the clarity from the government on this issue. Now something to dynamics waiting on Carelon. So lower member count within health benefits will create a headwind for Carelon in 2025, partially offsetting its pharmacy and services growth. And despite better than expected Medicare performance, management continues to expect a high single-digit decline in full-year operating margin. And lastly, Medicaid rate outlook is softening, so early input for 2026 points to 125 basis points year-over-year decline in Medicaid margins, indicating a continued pressure across state programs. Now a little bit on technical analysis. So the stock has staged a strong recovery since the July lows when it briefly fell outside of its 2 standard deviation range and settled near the 270 level. Over the following 3 months, it rallied sharply into the $360 area, which coincides with the upper trendline resistance, marking yet another lower high within the broader downtrend that's been intact since September 2024. Currently, the stock trades just below its weekly mean reversion zone, sitting slightly under $320. If momentum were to extend towards the upward trendline again, the next major resistance would appear near $350, while the 2 standard deviation boundary currently aligns around the $375 range. And my overall take is that Elevance Health remains in transitional phase. The company near-term profitability will stay constrained by Medicaid dynamics and policy uncertainty, but quality improvements in Medicare, growth from carelon, and early adoption of AI solutions built a case for gradual margin recovery heading into 2027. This is it for today's video. If you want written article on this, check my Substack. Also for daily insights and market updates, subscribe to my X account. And for more educational content, you can check my website. Links for everything will be in the description of the video. And this is it. Like and subscribe as a sign of support, and see you in the next video. Bye.